In this video, we will talk about sources through which a company can raise funds, what is meant by stock, how equity differs from debt, and what are the different types of stocks. Let us start by understanding the sources of raising funds. Did you ever raise funds to meet goals such as buying a car, house, wedding, higher education, etc.? You probably would have at some stage of your life. Typically, for individuals, this comes in the form of taking loans from banks or financial institutions. Alternatively, if the amount is small, we sometimes borrow money from our friends and relatives too. Just like we need funds to meet our personal needs and objectives, so do companies to grow and expand their business. The source of raising funds for companies comes in two forms: debt and equity. When companies raise funds through debt, they borrow money from banks or financial institutions in the form of a loan. Additionally, companies could also raise funds from investors by issuing bonds or debentures to them for a specified period. The other source of raising capital for companies is by way of issuing equity shares to investors. Equity shares, also known as stocks, represent part ownership in the company. For example, if a company has issued 1 million shares to its investors and you hold 1,000 of those shares, you are a part owner of that company to the extent of 0.1% of the shares issued. Let us now understand the key differences between equity and debt. 1. Equity holders are owners of the company, while debt holders are creditors of the company. 2. Equity holders are eligible to vote on important company affairs, while debt holders are not. 3. Companies are not obliged to return the capital to their equity holders, nor are they obliged to pay dividends. On the other hand, companies are obliged to repay the principal borrowed from debt holders on time along with the agreed interest. 4. If a company were to go bankrupt, debt holders will have the first claim on the assets of the company, while shareholders will be eligible to receive only the residual claim, that is, assets that are left over after all the creditors have received their dues. So, there exists a possibility that in case a company was to go out of business, equity holders may receive nothing. Because of this, investing in equities is considered inherently risky as compared to investing in debt. That said, as the company's profits belong to shareholders and not debt holders, equity is a more appealing proposition because of the possibility of earning a higher return on capital. As the company performs well, so does its share price, which in turn benefits the equity holders. Let us now understand the types of equity shares. Companies issue two types of shares: common and preference. What are the differences between the two? 1. Common shareholders have a right to vote on important company matters, while preference shareholders do not enjoy such rights. 2. Preference shareholders receive a higher priority over common shareholders when it comes to the dividend payment. 3. If the company were to liquidate, preference shareholders would receive a higher priority over common shareholders on the company's net assets. Typically, the objective of purchasing common shares is capital appreciation, while that of purchasing preference shares is the dividend. When people say they have bought shares of a company, what shares are they referring to? Well, they are typically referring to the common shares, which form a significant part of a company's issued share capital. Let us now conclude this video by talking about the key takeaways. 1. Companies raise funds by way of debt or equity. 2. Companies raise money from debt by taking a loan from a financial institution or by issuing bonds or debentures to investors. 3. Companies raise money from equity by issuing shares to investors who then become part owners of the company to the extent of their shareholding. 4. Common and preference shares are two types of shares issued by companies. 5. When people say they have purchased shares of a company, they typically refer to having purchased common shares. Well, that was all that we wanted to talk about in this video. We hope to see you in the following video where we shall speak of capital markets.